Silver didn't fall slowly. It didn't warn anyone. It collapsed in a single breath. One day, everything looked normal. The next day, confidence vanished. People think this was just another market drop, but markets don't behave like this unless something underneath breaks. This wasn't fear reacting to bad news. This was pressure being released. Because when an asset drops this fast, it's not asking you to sell. It's forcing someone else to. And the most dangerous thing in markets is not a crash. It's misunderstanding why it happened. Because the reason silver fell this hard has nothing to do with weakness. It has everything to do with how modern markets really work. Once you see it, this move stops looking random. It starts looking familiar. When people see a sudden collapse in silver, the first instinct is simple. They assume fear. They assume bad news. They assume investors panicked and rushed for the exit. But real panic doesn't look like this. Panic is chaotic. Panic is uneven. Panic creates hesitation, rebounds, confusion. What just happened in silver was different. This move was clean. It was fast. And it was one-directional. That tells us something important. Markets don't move like this because millions of individuals suddenly agree on the same decision. They move like this when structure overrides sentiment. Silver sits at a strange intersection in the financial system. It's not just a monetary metal like gold, and it's not just an industrial commodity either. It lives in between. That makes silver extremely sensitive to stress inside the system. When everything is stable, silver behaves like a commodity. When confidence breaks, it gets treated like liquidity. And liquidity is always the first thing markets reach for under pressure. This is the part most investors misunderstand. They think a drop means silver failed. But in reality, silver was used as a release valve. When leverage builds up across markets, equities, bonds, currencies, pressure accumulates. Eventually, something has to give. Silver is one of the easiest places for that pressure to be released. Not because it's weak, but because it's tradable, liquid, and heavily financialized. That matters. In modern markets, prices are not set by buyers and sellers of the physical asset. They're set by flows, hedges, and forced positioning. When margin calls appear somewhere else in the system, assets that can be sold quickly get sold first. That's not a judgment on their long-term value. It's a function of mechanics. This is why silver collapses don't feel gradual. They feel violent. They happen when someone needs price to move, not when opinion changes. Another mistake people make is assuming price reflects supply and demand in real time. It doesn't. Price reflects who is under stress at that moment. And when stress hits the financial layer, paper silver absorbs it long before physical silver reacts. That's why these events feel confusing. You'll see headlines talking about collapse while physical demand quietly stays firm in the background. Two different worlds, two different clocks. What you're watching during a move like this is not silver being rejected by the market. You're watching silver being used by the system. That distinction changes everything. Because once you understand that, you stop asking the wrong question. Instead of asking, why did silver fall? You start asking, who needed it to fall? And that question takes us to the next layer of the story, where paper markets, leverage, and control collide. One of the biggest misconceptions investors have is believing there is one silver market. There isn't. There are two entirely different systems operating under the same name. What most people see on a screen, the chart, the candle, the sudden collapse, that is paper silver. Futures, derivatives, contracts that represent silver but don't require silver to actually move. This market is fast, highly leveraged, and dominated by institutions that trade exposure, not metal. Physical silver lives in a different world. It moves slowly. It settles through logistics. It depends on inventory, transport, and delivery. These two worlds are connected, but they do not move together in real time. And during stress, they separate. This is the part retail investors almost never understand. When silver crashes on paper, it doesn't mean physical silver suddenly became unwanted. It means the financial layer needed relief. Paper silver is used to manage risk elsewhere in the system. It absorbs pressure from leverage, margin, and balance sheet stress. When that pressure spikes, paper markets respond instantly. Physical markets can't. They don't reprice every second. They don't liquidate because a hedge fund needs cash. They don't disappear because a balance sheet is under strain. So when you see a sharp paper collapse, what you're often watching is financial stress expressing itself, not a judgment on silver's real-world role. This is why experienced participants don't panic during these moments. They watch behavior, not price alone. They look for signs of strain, delivery pressure, inventory movement, unusual settlement behavior, divergence between regions. Because when paper price falls without physical supply loosening, it signals something very different than weakness. It signals imbalance. And imbalances don't resolve quietly. They resolve through adjustment. Another key misunderstanding is thinking that manipulation requires some dramatic conspiracy. It doesn't. Modern price control is structural. Large institutions don't need to believe silver should fall. They just need to manage risk. When enough leveraged positions exist, selling pressure becomes automatic, not emotional, not ideological, mechanical. That's why these moves feel brutal and sudden. It's not sentiment turning, it's machinery activating. And that machinery exists almost entirely in the paper layer. This is also why silver behaves so differently from gold during stress. Gold is primarily a balance sheet asset. Silver is treated as a liquidity asset. And when liquidity is demanded, silver gets pulled into the process. Not because it failed, but because it's useful. Understanding this is the difference between reacting emotionally and observing strategically. Because once you see that paper and physical silver are operating on different clocks, you stop assuming the chart tells the whole story. And that brings us to the most important question of all. If paper silver was being pushed down, what was happening underneath? That's where the real signal lives. While most people were staring at the red candles, something far more important was happening, and almost nobody was watching it. Because the most telling signals in precious metals don't come from price, they come from behavior during stress. When markets are calm, everyone looks smart. When markets break, the real structure is exposed. During this collapse, paper silver was falling aggressively, but underneath, the physical market wasn't acting like a market that had lost demand. In fact, it was doing the opposite. This is where most investors make their second mistake. They assume lower price automatically means lower interest. That's rarely true in commodities, especially metals with monetary history. When price drops violently, there are only two possibilities. Either demand disappears, or strong hands absorb supply from weak hands. And the difference between the two shows up in delivery behavior. Physical silver doesn't move on headlines. It moves when someone is willing to take delivery, store it, and remove it from circulation. That's a commitment, not a trade. During this decline, delivery activity didn't collapse. It stayed unusually firm. That alone tells you something important. Buyers weren't backing away. They were waiting. Another overlooked signal is regional divergence. If silver was truly unwanted, prices would fall everywhere. But they didn't. Different regions were valuing the same metal very differently. That's not a coincidence. That's fragmentation. Fragmentation happens when paper markets are under stress, physical supply is tight, and pricing mechanisms stop syncing. In other words, the system is trying to clear pressure, not reflect reality. This is why experienced participants don't rush to sell during violent drops. They ask a different question. Who is being forced to act right now? Retail investors act emotionally. Funds act under rules. Banks act under constraints. And when constraints tighten, assets that are liquid on paper get used as shock absorbers. Silver is one of those assets. This is also why crashes like this feel unfair. They don't reflect consensus. They reflect urgency. Someone needed to reduce exposure. Someone needed margin. Someone needed balance sheet relief. And paper silver is efficient for that purpose. But here's the critical part most people miss. Once forced selling is done, the pressure doesn't disappear. It shifts. Paper selling relieves stress temporarily. But if physical metal keeps leaving the system, pressure builds elsewhere. This is why these moments don't end the story. They start a new phase. A phase where price no longer reflects leverage, but availability. And availability is slow to adjust. This is the quiet handoff phase, where impatient sellers exit and patient holders step in. It doesn't look dramatic, it doesn't make headlines, but it changes the structure of the market, which leads to the real danger, not for silver, for people who misunderstand what phase they're in, because the worst decisions in precious metals aren't made during peaks or bottoms. They're made during transitions, and that's exactly where the market is now. If there's one reason most people lose money in silver, it's not manipulation. It's not banks. It's not timing. It's psychology. Silver doesn't punish ignorance. It punishes misunderstanding. And this phase of the market is where that misunderstanding becomes lethal. Here's the trap. When silver rises fast, people don't buy because they understand silver. They buy because price movement feels like confirmation. And when silver crashes, people don't sell because fundamentals changed. They sell because fear feels like information. This emotional loop is exactly what creates transfer of ownership. Let's break it down. Most investors secretly treat silver like a growth asset. They expect it to behave like stocks. Momentum up, arrow confidence. Momentum down, arrow danger. But silver doesn't follow that logic. Silver lives between two worlds. It's a monetary metal and an industrial input. That makes it unstable emotionally, but powerful structurally. During stress, silver is usually sold first, not because it's weak, but because it's liquid. When liquidity is needed, assets that can be sold easily get hit hardest. That doesn't mean they're unwanted. It means they're useful. This is where the psychological damage happens. Retail investors see the crash and assume smart money must be leaving. But smart money doesn't exit during forced liquidation. It waits for it. Professionals don't chase strength. They wait for imbalance. An imbalance doesn't feel bullish, it feels uncomfortable. This is why most people buy silver too late and sell it too early. They enter after confirmation. They exit during confusion. The market knows this. That's why the most violent moves happen when confidence is highest, or when fear is loudest. Another trap is anchoring. People anchor to recent highs. If it was here last week, it should be here again. Markets don't work like that. Prices don't owe anyone symmetry. They don't return to levels on schedule. Anchoring turns volatility into panic. Then comes the final mistake, comparing silver to gold incorrectly. When gold holds better, people assume silver is broken. But silver has always been more volatile than gold. That volatility is the cost of leverage and the opportunity of patience. Gold absorbs fear, silver amplifies it. That doesn't make silver inferior, it makes it harder to hold. And assets that are hard to hold are the ones most often mispriced during stress. This is why experienced investors don't ask, is silver crashing? They ask, who is being forced to sell silver right now? Because forced sellers create opportunity, not signals. The trap is thinking volatility equals failure. In reality, volatility is how ownership changes hands. And right now, ownership is shifting. Not loudly, not cleanly, but deliberately. Which brings us to the most important question of all. If this move isn't about weakness, what is it preparing for? At this stage, the most dangerous mistake is asking, will silver go up next week? That's not the right question. Short-term direction is noise. What matters is positioning. Because moves like this don't happen in isolation. They reset behavior. Every major precious metal cycle has the same structure. First, price disconnects from logic. Then, weak hands exit under pressure. Finally, the market reprices quietly, away from emotion. We are in the middle phase. This isn't about predicting a bounce. It's about understanding why this phase exists at all. Silver's role is not to reassure you, it's to test you. Gold is designed to preserve confidence. Silver is designed to transfer ownership. That's why gold stays calm while silver looks chaotic. Gold absorbs stress. Silver reveals it. This is also why professional capital treats them differently. Gold is accumulated slowly, often invisibly. Silver is accumulated after volatility, not before it. When paper markets are unstable, physical demand doesn't disappear. It reroutes. It becomes selective. It becomes patient. It becomes quiet. That's why price drops don't automatically mean demand drops. They often mean urgency disappears. And urgency is what creates bad decisions. The market right now is flushing urgency. This phase teaches one lesson. Price is not truth. Price is pressure. Truth shows up later after pressure has done its job. This is also where people misunderstand manipulation. Manipulation doesn't work unless psychology cooperates. If people didn't panic, these moves wouldn't work. Markets don't just move prices. They shape beliefs. And belief determines behavior. That's why the most important shift isn't in charts. It's in mindset. Silver should not be treated as a quick trade, a prediction, a reaction to headlines. It should be treated as a volatility buffer, a liquidity hedge, a structural asset with timing risk. Gold protects value. Silver tests discipline. If you expect silver to behave like gold, you will always be disappointed. If you understand silver's role, you stop reacting to it emotionally. And when emotion disappears, mistakes disappear with it. This is not a call to buy. This is not a call to sell. It's a call to think correctly. Because markets don't reward certainty. They reward preparation. Silver didn't just crash, it forced a decision. And the market always remembers who panicked and who didn't. If you want clear thinking about silver, gold, and markets without hype, fear, or prediction games, subscribe to the channel